Good day and welcome to FinChat Podcast, where I interview professionals in the finance industry to allow them to share their experiences and knowledge to the next generation of business people and entrepreneurs and expose them to the world of finance, banking and related topics. Today we're covering private equity in South Africa, personally one of my favorite topics. And joining to me today to chat a bit around this topic is Thomas Prins. Thomas is a seasoned professional with over 25 years of experience in private equity, investment banking and management. He is passionate about building and developing businesses and people and believes business is a key tool for creating sustainable impact on society. After completing his articles, Thomas joined Investec Corporate Finance in 1995 and in 1999 he founded Investec Private Equity. Until 2010, Thomas led the business in more than 45 transactions to build the business to now known as the Bud Group, which has net assets in excess of 10 billion rand. During his tenure at Investec, he represented Investec on numerous boards and was also a member of the Investec Executive Group of Management Forum. And Thomas is an independent director of 6 companies. He's also an advisor to a number of boards and to CEOs. Welcome, Thomas. Great
Thank
to
you
have
very
you on
much.
the
Thanks for
third-
having me,
very
guys.
first
It's a
FinChat.
pleasure to be here. Thank you very much. I'm excited to be here.
So first off, Thomas, let's start off with a bit of your journey into private equity. What was the process with you finding private equity, getting into it? What was your strategy? And what was a bit of challenges that you faced through that?
Josh, I think I stumbled into private equity more than strategized into it. I always wanted to be in investment banking, so that's why I joined Investec at the time. They were a fledgling investment bank just starting off, really. The corporate finance office, when I joined, I think at 6 people, I was the 7th employee there. Investec was still a small place, was in the mid-90s. And I wanted to be part of deal making and more the financial services system, and I thought that, the investment banking environment is where I want to start. I was fortunate to be exposed to the Investec brand at the time. The investment banking environment was really dominated by older companies like Standard Bank. There was a brand called UAL, which was bought by Nedbank later on, that dominated the industry, or the financial services industry. We were just coming out of the whole apartheid era, and so there was a lot of conglomerates that wanted to go overseas. So there was really an explosion in the investment banking environment, where everything was totally internally focused, maybe in the 20 years before that, or the long time before that. Now people wanted to go outside, opportunities opened up, listing offshore, buying international companies. And it was an exciting time in Johannesburg and in Sandton. So I started out advising corporate finance, mergers and acquisitions. Then the market started running, and Investec started participating in an activity we call the pre-IPO, which really is you invest your own capital into a business, you prepare it for a listing, and then between 6 months and 2 years later you list the business and you sell your shares. So you are the shareholder of reference on listing. And the small cap market boomed. There was a real sense that the small caps are going to be the big drivers of growth, which it still is, but there was a lot of interest in them, and a lot of companies listed in the time. They called them the listing booms of the late 90s. But in that time I realized that you make an investment, you are involved, but you're always far away. It's never yours. It's always somebody else's company. You make money on the back of somebody else. So I always wanted to actually own something. So listen, why can't we make an investment, own it, drive it, and participate in over the longer term? In those days, one of our biggest companies called Aspen was created. I wouldn't say it was created. Stephen Sart started the business in Durban, but his big leg up was when Investec and some other people bought a company called MacMed that was in trouble. It had some pharmaceutical investments, which was huge compared to where Aspen was at the time. So we merged Aspen into that and listed that separately. And Investec took a stake in that business, but in reality Investec could have owned that business. So if you look at hindsight, if Investec retained its shareholding in Aspen and never listed Aspen, it would have been a much better investment for it than the investment banking fees you made out of underwriting, arranging, doing the funding, and the Investec ended up with a 20% stake in the business. It sold that off over time. Now given, I think, a business like Aspen, they needed to be listed at some point in time because it was a big global business, and Investec didn't have the balance sheet to
But you feel
fund
they
it.
should have been held.
But I think
privately
if,
for a bit
well, if
longer.
they held that for 5 years and listed it 3 or 4 years later, the profits would have been a multiple. But it's also, a factor of where Investec was in its own life cycle. The balance sheet was probably still too small to carry that kind of equity on the balance sheet, and the business and the illiquidity of it probably scared the board at that time. So from a prudency point of view, that was the right decision at the time. But personally, I felt, let's keep it. And then the whole notion of MBOs, and it was really the development of private equity at the time. Also globally, the name or the word private equity became known as an investment banking term. You'll remember the books you've read, the Barbarians at the Gate. It was a bit of a swear word in the 80s. And it was the asset strippers and, people that destroy companies. And it started getting a name of building, outperforming the markets because of the kind of activities, although it's illiquid.
Especially a bit of activist investing, getting part of the board, helping develop.
Absolutely, and having an impact. And the whole thing of saying that when you buy it, you must have a plan. You can't just buy it and hope that the share goes up. And the real sense of ownership and the responsibility that comes with that investment. So Investec opened up to the notion of holding things for a longer term. And so we started small and with more what we kind of say overlends, where Investec would take a little bit more risk in a lending transaction, but take equity in the deal, end up with a significant stake in the business, and then get liquidity into its investment through repayment of a loan instrument, but then retain the residual in the equity, which makes good for the risk that was taken. Important in those cases to really look at it as an equity investment because you take equity risk. And then one thing led to another. We were fortunate that the economy grew, and we were successful early investments, which is good because then your investment committee starts trusting you more and more, and we were able to do more and more transactions.
So first off, it first started with some debt financing that converted into equity.
So our first
then you ended up with all these equity holdings that you actually just
our
bought
first
into
MBO was an equity overlend, where we actually overlended into the business, and we told the management, if you pay us our instrument back as a return, we will reduce our shareholding in your favor. So a ratchet mechanism was then manufactured, and we diluted from, I think, 49% to 25% in favor of management.
Just a simple example. Can you just explain that step by step?
Say you come to me, say I want to buy the company, but you're fortunate you don't have to pay too much for it vis-a-vis the cash flow, or an asset on the balance sheet that you can sell. And you say to the institution that backs you, say, let's buy the business together. You put the money in. Let's call it 100, but I know that over the next 2 years I've got 150 of cash flow coming in that I can dedicate to your repayment, either by selling off an asset, or I'm overstocked, I can reduce my stock, or my debtors book was, I can refinance some of that. And my cash flows are growing strongly, which was not reflected historically. Then I take the chance and say, okay, let me put in 100 as a loan instrument. We issue the shares for R1, 51 to you and 49 to me, or 60 to me and whatever to you. And we make a deal and say, if you pay my 100 back at a certain return, I think we had a return of, it was quite a high return, so I'm not going to say what return it was, but let's call it in today's numbers a 25% return. You pay that back at that return. Over the next 2 years, we put milestones in place, and then my 60 goes to 30, and your 40 goes to 70.
Okay, so you incentivize the payback.
But that was just the structure that was found those days. You find some of it in smaller formats, not as aggressive as those, because in those days we were buying a company at net asset value or a 3 times EBITDA, which you don't really get today anymore.
Buying at 10,
now you got to pay for a business that makes over 100 EBITDA with good cash flows. You will have to pay 5 to 6 times for that. So those kind of aggressive structures are not possible anymore. But it was the beginning. It was really the beginning of private equity in South Africa. So the whole notion of, and we're also fortunate that business that we bought in that example, a deal from an international fell through, and the local company, the local parent, had to sell. So we stepped into that breach and we said, okay, we'll take it, but this is our terms. And they had a different agenda. So they were listing in the London market. And they had to sell some of their local assets. They already told the international investors they're selling off some of their local non-core assets. So there was more to gain for them on the international listing than trying to hold on for an extra.
So you do sometimes get those deals
those opportunities.
Okay, fantastic. So what were some of the challenges that you specifically faced in South Africa with private equity? What did you do differently where in the rest of the world, South America, they do a certain way, but you had to do
I think
differently
our
in
market
South
was very
Africa?
undeveloped, so the technologies around the transactions were still, asset-based kind of finance. If you just look at the whole development of the leverage finance market, there wasn't really that when we started out. So the notion of, there was some of that, but using the cash flows of the business and banks funding that as aggressively as they do today and having those kind of teams that focus on that wasn't there. So you really, you used asset-based finance, you used...
So where did you get the funding for your first deals? Did you
Well,
first get it
obviously
from
we
the
were
bank?
Investec, yeah, we were in
So you
Investec. So that it developed concurrently the two kind of industries. The leverage finance industry developed as the private equity industry developed.
But you
and the
use
deals,
depositors' money to make the deals,
when
which
the-
was a bit more forgiving before the Basel.
No, as you
started
remember,
coming in.
of the bank's capital, only about 8 to 10% of a bank's capital is depositors' money.
Oh, okay.
So you can leverage depositors was 8 to 12
Oh, you
times.
could
I'm not-
leverage it, yeah.
Depending on the capital adequacy, I think some institutions run between 15 and 20% capital adequacy. So
Yeah.
if you had 20%, then 5 times. You can leverage 5 times, your capital.
Okay.
Um,
So then
so
you
your-
got that
your-
debt
your-
from the
your-
rest
your-
of the banks.
No, from a bank.
From
we
a bank, yeah.
borrowed from Investec, yeah.
Okay.
No, so don't tell your listeners that a bank takes the depositor's money and then put it into deals.
Yeah,
It's-
no. I just
it's
want to
only a
understand
piece-
that
it's only a
relationship.
depositor's money is only a slither of a bank's capital structure,
Yeah.
which it uses to lend. So it takes money from depositors, brings its own capital, it borrows money in the market from the Reserve Bank, etc. So that's how, and then it does deals on this side.
Yeah.
And then that's why the regulations state they can only invest a certain percentage of their capital in equity, and that only a very small piece in unlisted equity.
Okay.
That's why you find internationally banks have all come off investing in private equity off their balance sheets. They don't really own private equity businesses anymore. Banks that still do this mostly in funds.
Yeah, because
The
of that
Standard
capital
Bank doesn't do it
adequacy.
anymore. Yeah.
Yeah, it's expensive.
ABSA sold its private equity business. Nedbank started now again, but it's very small in the context.
RMB, as far
RMB
as
has
I-
always
RMB
been,
still
but
has a
it's
big
in the first
portfolio.
rank stable, so they are able, because of their underlying investments, they can keep it on another balance sheet. But they've always been in the private equity industry through RMB
Space.
Ventures and then their shareholding in RMB in Corvest.
Okay, cool. So let's talk a bit about the process, the timeline of a deal. So from where you find a deal to how you think about it, what are the risk assessments that you do? And
Can we maybe take one step back before I go there? I think
Yes.
for your listeners and the students, I'll quickly explain just what private equity is
Yeah,
vis-a-vis
please,
the
yeah,
different
please.
asset classes. So the private equity is really what it says, private. So it means it's an investment in an unlisted equity. So it's private companies, where the majority of the capital that's invested on behalf of our pension funds and provident funds, the savings industry, that your Coronations, Old Mutuals, Allen Gray, Sanlam, invest, that's in listed equity that are listed in the JSE or in another exchange. The capital that we invest in unlisted businesses, so it's private companies, so they're not listed, and therefore the shares are not really liquid, they're not traded on an exchange. They can trade between parties, but it's very illiquid. You must go and find a party to buy that. So that's a big difference between the two kind of investments, is that it's very illiquid. So you only get liquidity, you sell your shares when substantially most of the shareholders sell, because it's very difficult selling a minority stake in an unlisted investment. So I think that's the big, and the source of capital that you invest in that comes from a couple of places, mostly again the pension and provident funds. They put that into funds, and then and that's a fund management model where you'll raise money from a pension fund and then invest it in unlisted businesses, sell that and give the money back, or what we call captives, like the PIC. They have a fund which is called the Isabaya Fund, and they are a big piece of our industry. RMB Ventures is a captive fund. It's an on-balance sheet fund, so there's no obligation to go and sell it and give back the money. It's their internal capital management. IDC, to the extent they invest off their own balance sheet when they buy stakes in businesses. I think that's I think the listeners will understand that big difference. Is that
Yeah, and I just want to touch on that also. If you guys want to know what some of the terms are that we speak about, please go to Investopedia and Google these terms and find out what they mean. I know you can go into depth and watch a lot of videos to enrich your knowledge further on these things that we talk about, especially on small terms and acronyms that we mention. So yeah, please go check that out on Investopedia.
Good. So the process of a transaction is really, when you have money, you have a mandate to invest it in a certain specific environment, right? So you get health funds, you get general funds, you get energy funds. So people in South Africa, generally, the majority of the funds that invest in private equity are general funds, because our economy and the economy of the region is quite small. So for you to go and raise a dedicated fund of any size, it's difficult to deploy that money then, because you must actually absorb all the deals in. You can't take 100% of the deals. So the majority of the funds are general. The process of a transaction is then, you would then go towards teams go towards their strengths, or a lot of the time it's a bit of luck in the beginning to get traction in the market, to get a transaction. A transaction is really where where a parent company or an owner of a business want to sell it. So it enters into the market, say, I want to buy the company, or I want to sell the company, and then the management team normally is in a good position to be backed to buy it. Then your private equity investor will come in and say, we'll buy the business, but we want the management involved. We'll evaluate if the management is good, if the business model is good. And then we'll put a proposal on the table to give cash to the seller. We'll put the capital in, and we'll incentivize the management with a stake in the business. So the management, we call that a management buy-in. So the current management, or a buy-out, the management stays in.
And that's where that earning back
sometimes they
comes
are
in.
that, or they just get these days there's a lot of different structures, so it's very developed. There's exit incentives, there's earning incentives, so there's different ways of structuring. In essence, it's a very nice way for management, if their parent want to sell, for them to get a big piece of the action in the buy, because the money coming in are normally managed by financial services people. They don't want to run the business, but they want to own it, and they want to back the management to run it for them. The majority of the transactions come through that. When you talk to people in the market, the majority of them will tell you that we'll find our deals on a proprietary basis. What that means is we don't stand in an auction, because if you want to sell a business, you normally go to an investment bank or an auditing firm. You say, go and sell the business for me. They run an auction process where they present you with do an investment memorandum on the business, and then they give that out to selected parties, and then those parties bid for the business. They select the 2 or 3 best bids, and then there's a winner. And
that's very competitive.
It's a very competitive, and that's normally finely priced. So what you want to do is you want to end up hearing about transactions that somebody in the process is in a proprietary or in an exclusive kind of positioning because of where they are, their relationship with the seller. Whether it's the management team, and the management team have worked for the family for a long time, and they said, okay, we'll give you first bite of the cherry, but we want X. So if you can give us X, we won't put it into a process. Then you can spend time with that man.
Price number one.
That's price number one. Or where you go, what we do now in the industry, we actually identify businesses that we want to buy because of our own proprietary knowledge. I think, for example, if you think the gas industry in South Africa is going to develop. South Africa is very underdeveloped in the gas usage by our national consumer and industrial companies. It's really because of our historic the availability of gas. I personally think gas is going to develop, so I'm looking for gas companies to buy. So I'll make it my business to know who are all the gas distributors in South Africa, what does the value chain look like, where are the critical phases in that value chain, who owns them, what are the licensing arrangements, who has those licenses, and then we proactively approach those owners and management teams to say 2 things. One, if your business ever becomes for sale, tell it to me, and you then proactively market to those people by your interest in their business. If you find something else, you phone the MD, say, hey, did you read this in the paper today?
You build a relationship.
You build a relationship with that management team, that they trust you, that if they come into position to buy the business, they call you. Secondly, also with the owner, because a buy and a sell is a lot of trust in that whole thing, because it's a 6-month to a 12-month process. You market yourself to the owner, say, I want to buy a business, I have the ability to buy it, and I have knowledge of the business, so it'll be in a good pair of hands, and I have a strategy for the expansion thereof. You demonstrate that to the seller. and then so you start identifying businesses before they come to sell, and then you also market yourself to brokers in the market, the auditing firms, the business, not really the business broking.
Because they also know who knows what in the industry.
Who's going to be the investment bankers, the corporate finance officers in town, the big private equity houses are always, and also conversely the investment banks market to the private equity houses and say, I think this listed company should shed these 3 assets, and we should buy them, and you should do this with them.
Okay.
And let's take them a deal, and let's go and buy it. So there's that kind of activity in the market where assets are identified.
So and then where do you go from there? Then you make a deal with management, and how do you get some debt financing? You mentioned.
There's first the process of information gathering and upskilling yourself about the business. So what can I do with it? Because really, when you pay something, you must make a return for it, right? So you must know what you're going to do with the business, because you can't sell your shares when you're unhappy. When you're unhappy, when you want to sell, then your shares are worth less.
So what are those risk management and due diligence?
Well, you look at the market. Firstly, you would look at where the business is positioned in its market, the competitive forces in that market. What are the competitors? Does it control the value chain? Are there risks in that value chain that it has critical dependency on a certain supply or a market, or access to a consumer or its users, its client base? What disruptive things can happen in the market? You look at the track record of the management team, how long they've been together, their own track record in the industry. Then overlay that with the general economics, what are the forces that play around? And then also, the value creation opportunities. How can you integrate upstream, downstream? Can you make good acquisitions to expand your reach? Because a lot of times what people do, they do what they call roll-ups. So if there's an industry that's in high growth but it's still very fragmented, they would buy the number 2 player or the number 3 player with enticed new management and then roll up. So you pay you pay 5 times EBITDA or a PE of 10 times for your first acquisition, but then you can roll up a lot of the other places, the market, for a 5 PE or a 2 times EBITDA, because they're a lot smaller, they're illiquid. You can you call it the roll-up strategy. So you look for what strategy you can present.
Yeah.
You do your models, your forecasts. What kind of returns do I get, and then you can decide on what I can offer. In that process, you also talk to the banks to decide how high will they gear it for you. You then select a funding partner in that process. So First Rand, Investec, Nedbank.
Sometimes do you get a mandate from those?
Oh yeah, you select a partner. You bring them into your transaction. They go for credit approval. You say, I want to submit an offer to buy that business for 500 million rand, and I want to borrow 250. Go to your credit committee. Here's my proposal. Here's what will structure the deal. These are the assets, and then they go through credit. So by the time that you put forward your bid, you've got a credit approved debt. You've got your own investment committee have approved your transaction or your 250 if that's up to you to do, and you can make your bid.
Okay, cool. And
then there's a due diligence exercise at the back end. So once the people say, okay, I accept the price, it's good. Then you do a due diligence on the business where you appoint third-party advisors to go through the books on the one side, commercial due diligence where you sometimes...
the plans start getting going.
No, it's more your third-party advisors, like the commercial due diligence on big transactions. You use a Baines or
But is that to make that's after credit approval? But
that's to check your assumptions in your plan. To confirm that. You say, I've made the assumption that the industry will grow at 3%. Now, obviously, in your own proposal, you go to the market and you mine that. But then to get confirmation from that, then you start...
So you actually get credit approval before this?
But it's always subject to a due diligence.
Okay.
Because the due diligence exercise is a costly exercise. You don't want to do that if you don't know the deal is yours.
Okay.
But once the deal has been consummated and the guy have accepted your pricing, you say, okay, let's do the due diligence now, which confirms all my assumptions. Because I've told you, listen, I'll pay this price, and in my due diligence, I want to check these things.
And how long is that? Because you obviously have to talk to the management.
For a normal transaction, it's between 4 and 12 weeks.
Okay.
12 weeks is a long time. Then it's a very big and complicated transaction.
Yeah.
I would say probably around 6 weeks due diligence.
And that's also, you have to talk to management then.
Yeah, the auditors will then obviously go through the historic numbers, check the balance sheet and do that. You'll have sometimes marketing people that look at the market and the competitive forces. You have the management consultants that can calculate your strategy, and you yourself. I always say that if you're the owner, you cannot buy the business without really knowing it. So I talk if I'm a principal in the deal, I talk to the key customers, to the key suppliers, I even go and see some of the competitors to understand, because a supplier tells you a lot about a business, because he's got a very intimate relationship with it. The key customers that have been with the business, they tell you where the market is going for that product, because they consume that product. Competitors tell you things because they are in there. The people at the door, at the gate, the secretaries tell you who does what in the business, who doesn't pitch up, where the relationships are, and the things that you don't want to know. So that's the kind of stuff that I, as a principal, do. But you still need the official documents from the tax due diligence, legal due diligence to sign off to release the money out of the banking system and out of the fund system.
Okay. And you mentioned a bit about the tight liquidity with your exit. So that's obviously part of your planning.
Part of your planning is, can I sell this business and whom am I going to sell it to? And it's most beneficial if you afterwards can sell it to a wider market that has reason to buy it, for who it has strategic nature. So we always look and say, can I build something with the business I'm buying that will have strategic importance for 2 or 3 other players, because then there's a competitive environment. So then I can get competitive tension from bidders in my in my process in the back end.
What is your return that you want just on the buying price and your selling price? You want like 10 times more?
Money in, money out is about 2.5 times 25%.
Over 10 years?
Over a 5 to a 10 year period, depending on what you do, because of the risk situation, I've got colleagues that have just been overseas. They say now that you won't get dollar funding if you can't give them a 30% return and 3 times money back. So for the international investors to invest in South Africa, that's what they want on their private equity money. Because of the illiquid nature, they'll probably take less a lot less in a liquid JSE investment.
Do they have any sustainability and ESG requirements?
Oh, absolutely, that is a big theme. I think the belief of business owners that a big piece of the return and the responsibility will come out of ESG. We haven't seen it historically, but there's a big belief and a drive. So when you go, especially when you go into mainland Europe to raise money, and when you sit there in our big institutions, they spend a significant time of their interview with you. What are you doing about the environment, the sustainability? And what is your view? And what have you done historically? And how do you view? But if I always say in private equity, most of the investments are impact investments, because you buy something to grow it. And when you buy something to grow it,
social impact,
because the asset stripping has really been arbitraged out of the market. So being able to buy something and strip it into pieces and sell it off and then retrench people, those businesses don't really exist anymore. So the market is quite efficient. So if you buy something, you pay a good price for it, you need a plan for it to grow, and the only way that you can get a return is if you know how to grow it. Growth normally means creation of jobs, expansion of a market.
Yeah, because I think there's more to think about it, especially in the ESG space. So it's not just the environment. The environment's very, very important, but there's also people's lives and all this. There are six different capitals that have to be taken into account with your sustainability.
I've got a conviction, Josh. I think the thing that most people would want from our president in South Africa today, if you ask them, a job.
Yes.
Don't come and talk to me about how to farm in this. Yes, that's sustainable kind of issues. But the first thing is a job. If we can create jobs and give people pride in what they do, a sense of being, a sense of worth. Because when you give somebody a job, you give them him or her worth. They can then go out and they've earned something, and they can then provide for the people around them. And then secondly with that is development.
And I think that's what they talked about.
Because in the job you have margin to develop. In charity, I don't believe we have margin to develop. In job creation, I have both an incentive and margin to develop. Because if I take you and you're a good employee, I have an incentive to retain you. So the only way I believe I can retain you is if I give you a career. And in that, I must then be prepared to develop you. Because I want the best out of you, I need to develop you. Whether you are qualified as you guys are, or whether you are unqualified. If you have a good attitude and you've made your mark and I want to retain you, I need to develop you. So I believe that what we do in private equity is impact investment, just by the fact we are factoring what we're doing, because we own the business.
And grow business.
I'm not knocking my colleagues in the listed market, but their impact on the underlying investment is through other parties. Is once a year they will engage at the AGM, what have you done about this, why are you overpaying the CEO? And they'll lobby in the press. I have the responsibility of interacting with the management team on a daily basis. I'm the owner of the business. or I set policies. I'm the chairman of the risk committee. I work with I set the KPIs for the executives, or we set the incentives, the strategy for the business. So it's our responsibility where that is going.
Yeah, and we've at a previous FinChat, we spoke about how important it is to set the right KPIs for management, and now
absolutely
that measurement is extremely important.
No. So I believe that the board's first and major responsibility is to appoint the appropriate executive.
Yeah.
And that's why we have, I think in over time, if you look at the corporate failures in South Africa, is because the board have forgotten that it's their role to manage the CEO. And we have these bigger than life kind of CEOs, they've got the board in their pocket.
Yeah.
That's why people internationally are driving so much for independence on the board, which I don't really buy into in terms of the way that they define it. But be that as it may, it's a good drive because the board needs to manage the business through the management team.
Okay. Yeah, I understand. All right, now let's move on a bit to the private equity industry. On the 21st of October, Business Day published an article explaining that about a private market bubble. I think you sent it to me. And I'd found that through all this money going to private funds and venture capital building up, especially in America, and then private equity firms taking over those companies, where there's a lot of money going into the private market. But as soon as those returns can't deliver, they'll run to the public market to obviously sell off for the liquidity. Now, what do you think the impact is of private equity in that private market bubble, if there is one?
If you just look at the behavioral, because finance is behavior science. People allocate their money based on what they believe in, not really what is actually happening, because normally the majority of investors or private investors they follow trends, and they don't really do the due diligence.
Like we see with tech, all the money just running
everybody's
into tech,
going into tech. So what has happened in the last while is because of the successes of a Google and a Facebook and the like, and then becoming in the lifetime of the CEO, Apple, the biggest companies in the world, people are very afraid of losing out. So that kind of behavior saying, you cannot afford not to participate. So the reality of valuations and that have really overtaken the people that drive to participate because of the examples where people have missed out, and only a few have made zillions.
Yeah.
I think that's the one thing. The other thing is that drives the behavior is the lack of yield in the international market. What I mean with that is that investors generally don't get returns at the moment.
In the public market.
In the public market. In some countries, even government bonds give a zero or a negative return. So investors are looking for a yield. And if you talk about even people that have never invested in the private markets, they say the lack of yield in the public markets are forcing us to consider the private markets, because there still seems to be some yield. And it's really out of the technology in the market maybe a little bit, and a little bit of inefficiency, but then these things that people come around that you read about, the Facebooks and the Googles that people invest in, and they become from small companies to big companies, the unicorns that they talk about. But now so much money is going into that direction, and there's this pressure that people have. I have to spend the money. So when you raise money from pension funds, you promise to invest that money over a 5 to 7 year period. So you got to go and find investments for that, and you compete all the time. So the power has really shifted to the owners of businesses, and we're seeing valuations in the market like we've never seen before, because the exit values have been so low,
Yeah.
And we've seen recently a bit of a pullback.
But just a couple of them, though. They haven't been like hundreds of massive exits. It's been 10.
Yeah, but you still read a lot about the unicorns. They may not be listed, but they still raise money at high values, So early investors are making good money.
Yeah.
With the WeWork failed listing and those kind of things, there has been a bit of a pullback in the valuations.
Yeah.
But I still believe there's and you're right. I think the jury is still out if those companies, even the Facebooks and the Ubers, they say, the Uber guys say I might never make a profit. I don't know how you ever give a return to your shareholders if you don't give them a dividend.
Yes,
I still don't understand that. Maybe I'm old school. But value at the end of the day isn't only in perception. It needs to translate into a return to an investor.
Yes, but let's talk a bit about those valuations that you mentioned, because previously you mentioned that you used to buy a business at 2.5 EBITDA, and then got higher, and now it's 5 and 6.
Yeah.
But now the actual what's happening in America is with these tech companies, private companies are already raising capital at 20 times EBITDA. Or you can't even measure it against EBITDA. They have different multiples to measure it against, because they actually can't use earnings because they don't make earnings. So they value it based on a revenue multiple. Like I think Uber, I think you told me this, that Uber and Taxify, how they value them is like 3 times their
number of rides,
kilometers, and how
something
the effect of that. I mean, we're sitting on the people saying that 25 times or 25 PE of a public tech company is reasonable. Where now, I mean, Warren Buffett or Benjamin Graham used to say if there's a PE above 20, it's crazy overvalued. So, what do you think actually the effect is of private equity, or even the venture capitalists getting in first, selling off to the private equity companies who are just like running for those multiples, trying to get a massive revenue over a massive amount of rides. Let's talk about like Uber or Taxify, and then IPO that into the market. And then we just see major losses of these IPOs in the market. We see the failure of Uber, or we can't call it failure yet, but like the downturn of the Uber listing. What do you think of the effect of those just going for those multiples, not really caring about the earnings?
No, I think markets always overreact and then come back to some kind of a normal. So we're still in the middle of that game playing out, or the movie playing out in front of us. So it's difficult to say where it will end. And there will be winners, because when you convert something into cash and that sits there, all the new fintech things.
I mean, the private equity guys won there.
The banks, if you just take it from a business model away from the things that where I'm more comfortable talking about, maybe the financial services system and the fintech companies that are starting up, there's clearly a lot of margin in the financial services businesses. There's huge margin in that. Now, clearly they take risk, etc., but there's probably a different way of doing it. So, the banking industry has been very, very long standing on a certain way, and I think some of those interventions will be successful and will turn into cash. So just, if you are prepared, if you are able to get a certain percentage of the market, you guys were still very small when Mark Shuttleworth sold his company to VeriSign. It was the biggest, it was a $300 million deal, I think, or 350 million. I can still remember the number that he sold his business for. But at that time, he had a 40% global market share, something like that. And he was on cash turning, and you could see in the business how quickly it's going to turn into cash.
Okay.
So it was a huge multiple, but you could see it. Now, that's obviously the investors take different views. So some of the things I can't understand, because I don't understand how some businesses are going to turn to cash and how significant that ramp will be. But in some other things I can, because if you can do the calculation in a payments technology, if you can convince the market to channel a certain amount of traffic through your pay gate or your switch, and you can charge them a margin on that, where a bank will charge 5%, charge 2%, and you get that, and you can deliver the cost, and you don't have all the other costs. You can see the cash is going to drop. You must capture the market. So now you're backing somebody to catch the market. Like in the .bomb days, people were backed to catch a certain percentage of the market, because then that will convert into earnings.
Okay.
And Amazon, for example, there was back to go and grab that market, because that was and then we will convert into earnings. I don't see that in some of the businesses.
Yeah, but
and we'll see.
In tech, I think it's difficult because tech has such a low switching cost. I mean, you can choose easily. If Taxify becomes just as big as Uber, you can just download the app and choose to use Taxify. So I mean, that's.
Yeah, but I think your friend here in marketing will tell you there's difficult. The first one in the market, the history tells us, have always been the biggest. Why SLC failed. We actually have enough people in South Africa for 3 cell companies.
Yeah, that's true.
There's enough margin in that business for 3 cell companies. But I think MTN and Vodacom has such a long runway before SLC came to the market. They were always on the back foot. Maybe if the 3 of them started together, it would have been a different story, and we would have had better service in the market than a third thingy. So it is, the people, and that kind of behavior is played out historically. So the investors understand, if I pick the right and give him enough gas to actually run and grab the market, he will probably hold on to that if the service is okay. Even though technology can switch, but people are used to. I've now I've got Taxify and Uber on my account, but I Uber the whole time.
Still Uber,
Not
yeah,
because
same, I'm still Uber, yeah.
I'm so loyal. I just have it. It's just I'm in the habit of Uber, and I know it
understand,
now,
yeah.
and I'm comfortable with Uber. You know,
Yeah.
so for me
Even
to-
if Taxify is cheaper.
yeah, I didn't even know what the rates are. I don't even go and check for Taxify. I'm just coming here today. I Ubered.
Yeah.
It's cheap enough. I
Yeah.
didn't have to go and it was
Yeah.
26 bucks. I didn't have to go and find out if I can do
Wow.
it for 15.
Fantastic. Thank you so much. Okay, let's get into our last section, the Q&A of the podcast. So this is just going to be a couple of questions that we ask every guest. Yeah, just answer them quick. And
Yeah. Okay. Let's see if
so
I
the
can.
first one is, what was the first ever job that you had?
The first ever job.
Yeah.
Well, does vac jobs count as when you
Anything from your child
I
delivering,
think
delivering
working
papers.
in the
anything.
garden and washing cars. I did a few vac jobs when I was at varsity. I worked in a butchery. I worked in a restaurant. Didn't like it very much, but I thought I'm a student. I was resting my holidays, but I did a bit of that. But I think the first real job I ever had was when I went to the army. I was, and then after that, I went overseas and I did various things. I worked on farms and in a pub and drove trucks around in America.
And what did you do with the money you made?
I toured. At that time I
toured?
toured around. Yeah, I toured Europe with that money. And then my articles, I never thought articles was a job. I hated articles. If I could do anything again in my job, I would redo articles because I thought I had a bad attitude during my articles. I think it's a big learning. Whatever you start with your first job in your environment, it's a big learning thing. I was a bit older and I thought, I want to go and be a CA immediately. These guys can't teach me anything, I was a bit arrogant. So I did articles and then and I would think Investec, I was a very good employer. Taught me what I knew.
Fantastic. What do you love to do in your personal time?
I spend time with my family. They say I'm not there, I'm thinking about work. Yeah, I'm quite active outdoors. We like to cycle and run. Go into Africa with our 4x4. We love camping as a family. We do a lot of that. We love skiing. It's very, very nice family activity as well.
And you recently moved to Camps Bay.
And we like traveling. My wife and I, we love traveling. If you could probably give her enough money, she'll travel all the time. And we are fortunate to live at the sea again, so we love the beach and that environment.
Fantastic. Tell us a bit about a person or persons that had a special influence in your life and why.
I think my wife had probably the biggest impact in my life. She was always she is a person that keeps you north, and is very honest and unafraid of asking the difficult questions. And although she sometimes doesn't think that she's got a very sharp business brain, even if sometimes she doesn't know it, she asks the right questions. And especially around the environment of integrity, are you actually trying to oversell something, or are you righteous in what you're doing? So from that point of view of a spiritual and the person that I am and the way that I think about how you present things and approach them, she had a huge, the most significant impact in my life. I think from a business point of view, the whole environment and the development of the investment banking industry, the Investec and its management from the early 90s to the late 2010, even today, had a big impact in my life. The way that they viewed business, the way that they challenged us when we presented transactions. And I think thirdly,
Who is that?
the Investec executive,
executive.
people like Stephen Kossef and Bernard Cantor and Brian Cantor and Glenn Berger, my ex-boss Andy Leith, which is the way that they think about business. And I think thirdly, the people that we backed, I was fortunate to be exposed to very good and very, I was young, I was in my early 30s, and the management teams that we backed, the CEOs were in their late 40s, mid 50s, experienced business people. And I was fortunate to buy into good and long-standing companies. Corrobrick was a more than 100-year-old company that we bought. PG Bison was more than 100 years old. And I was exposed to the leadership in those businesses, and they really taught me a lot about how they ran their businesses, the history of those businesses, and the way that they looked at it. So, in a lot of instances, these are things that you catch. It's something it's caught, not taught. Kind of, you know what I'm saying.
Yeah.
You learn it by being present and being attentive and constant, you know, absorbing, as opposed to learning. Being able to give an exam and write an exam about that.
Yeah. So on that point, actually, what was the best deal that you've ever done?
Yeah, we were fortunate to do a few transactions. I doubt if this podcast ever goes and some of my people say, I've singled out one, you know.
Yeah.
But we were fortunate in those days that we could buy at good prices, good management teams, and we could pay back our own capital quite quickly. And you guys that do maths and return calculations, if you give out 100, the quicker that you bring back the 100, the higher your IRR goes. Even, you know, the times money and IRR sometimes work against each other. And we were fortunate in the deals we did in the 2000 to 2005. We could structure in a way that our capital came back to us quite quickly. So the money that we invested came back quite quickly. So in that way, we invested nearly R1 billion and returned probably 1.2 billion rand over a period of 6 years, and that's created the momentum in the business and the confidence that there will be a big return.
Okay.
So I wouldn't say it was one deal that was the best. It was the way that we did them.
Portfolio of a deal.
Yeah, that we were fortunate to bring back the capital. We didn't. You know, today, if you go and buy a business for 7 times, it's difficult to repay 7 times of cash flow quite quickly because the business needs to expand. Yeah.
Okay, and tell us about a time you failed, what you learned from that experience.
I think the time that I failed was getting involved in things that I wasn't really, you know, after leaving Investec, I spent a lot of time in smaller businesses, and this is not talking against smaller businesses. I'm saying there are horses for courses. Everything that I was taught in the previous 20 years were on big businesses with management teams, and where there was margin in the business, and then you could move people around. And then I tried investing in smaller businesses, and what is hard about investing in smaller businesses is that the business itself hasn't got enough margin to appoint a lot of people. So it takes a lot of your own time for not as big a return. So that's why smaller businesses normally have a CEO, and it drives it, and it depends on that CEO a lot. Because until it becomes of size where they can start appointing proper people, you know, and qualified people. So I think my biggest failure was, if I say a failure, it was a big learning school for me, but it's to apply what I've learned in an industry where I didn't have experience. If I should have sort of stayed in bigger companies and working with management teams that manage bigger businesses.
Okay. What are you most excited about in the private equity industry, and what do you worry about the most?
Well, I'm excited about the private equity, the development of the venture capital industry in South Africa in the last 5 years. When we started in the 90s, there was venture capital was you only got them from friends and family. Certain of the communities, like the Jewish community, had a very developed sort of system where they would invest in their friends and family businesses as a natural course, whether that was a cafe or a video store or a new technology. So there was some money available in that kind of environment, but today I think our venture capital market is really developing. There are people that are professionals that understand that industry. It's probably the one side of our market that's still attracting international investment. I've just been party to where a foreign fund invested 200 million rand more than that, 250 million rand into a single company in South Africa, and venture, which is still early phase, which is, I'm very excited about that. And I'm diving into that side of the market because I think that's a big growth. I think we've got a lot of talent. Your generation is really coming. You're catching up on the way things are being done. You are much more exposed to all the global thinking, and you can, through your podcast that you are doing and other you have access to that, and you think a lot more. So I'd like to be I think that's a very exciting. What worries me is the traditional private equity market. I think the raising of new funds have really slowed down to a trickle. There's very little new money coming into the industry. If the PIC is not investing, and they're not really investing. And I'm worried that they are setting up people to fail. And what I mean with that, they are setting up maybe too inexperienced people, and they're giving them too little money. Again, the small business syndrome. They give somebody too little money to build a business. Because in the industry, if you manage funds, you charge fee. So if your fund is too small, then your fees are too small to sustain yourself and build a team. So you never get off the ground, So if you're not very, very lucky, and they're giving like 500 or 200 million rand to people, that's not enough money for a person to build a business. And even to fail, because when I started, 4 of the 5 people that I appointed left after 2 years when we started Investec Private Equity. And you need to be able to go through that. And in a small business, you can't. It makes you fail. You can't afford it. So I'm worried about the money raising and the money flowing into our industry and the way that the historic private equity industry is the current state of that. I'm worried about that.
Okay. Thank you. What advice do you have for a student or young professional starting out or considering a career in private equity?
I think the biggest thing is private equity is not somewhere you start. It's somewhere where you end up and then you work there. It's difficult to go through a process and say, I'm not ready to move into private equity. So, and our private equity businesses in South Africa are too small to actually take people, and they don't really do it from graduation. So they normally take people in from other places. And I think if you want to end up in private equity after varsity, what is your route? Is it investment banking? Is it through an audit firm? Is it through management consulting? Is it because you'll learn a skill that you can go and apply in the industry, and the teams that people are building are not financial services only. They take people, the team that I've managed, we always had people out of industry, people that ran businesses with marketing experience, with operation experience, and we marry them with building a team with financial services skills. So I think that's one thing that you must remember. And the second thing, if you end up there, it's not a short term to make money. And the funds are raised on a 5 to a 10-year period. You only make profit when you sell your last assets, which is in year 10, sometimes in year 12. So it's a journey. It's not, you don't hear, you hear about somebody, I invested in this thing and I made a lot of money 2 years later. That doesn't really happen. You create substance over a longer period of time.
Okay. What do you know today that you wished you knew when you first started out?
How difficult it is to raise money. When we started out, we had dedicated funds because we could go to Investec and I could fight there. Now you got to go and convince people to put money into transactions, and that's a skill that I never learned, and it's a hard skill to know where all the money is to invest. Because you can say I've got the deals, I'll get the money. Getting the money is the hard part.
Yeah, and keeping the money.
Yeah, so I've learned how to get the deal, but raising the money and convincing the pension fund or a family office to give you money to invest in your fund or in your private equity deal, that's a difficult thing. And I haven't really focused on that historically, on that piece where the money is.
All right, thank you so much. Thank you, Thomas. Thank you so much.
Thank you very much for having me, and all the best to your listeners and to you. I think this is great.
Yeah, thank you so much for joining us. I would like to encourage the listeners to please re-listen to this podcast. We learn from repetition. And please Google any terms that you heard in this podcast, enrich yourself and go Google and learn a bit more about this. Our access to information is incredible in our generation. Also, I just want to say thank you to Tuto Digital. Special thanks to my producer, Leka Lakala. I would love to hear your feedback and recommendations. Please make sure to leave your thoughts in the comments wherever you listen to this podcast. I'm Joshua Prins. You've been listening to FinChat Podcast. Until next time. Cheers.